Hi everyone, my name is Paris McCollum and I hope y'all are having a wonderful day. Today we are going to discuss three different types of crime. The first is ocean piracy, the second is mortgage fraud, and the third is insurance fraud. And we will use three different types of criminological theories that explain each crime. The first criminological theory we would use is social disorganization theory. The second is strain theory, and the third is the routine activity theory. We are going to use these criminological theories to better understand why these crimes happen, as each one is very different in terms of setting and method, but they all share something in common, and that is that they are shaped by the environments people live in and the choices they make when systems break down. So let's start with something a little dramatic, which is ocean piracy. When we hear the word piracy, most of us think of something out of a movie or something out of the history books. Most of us think of eye patches, swords, maybe a parrot. We think of Captain Jack Sparrow or Blackbeard. But modern ocean piracy is very real, very dangerous. It involves criminal acts committed at sea. Some of these acts include hijacking ships, stealing cargo, kidnapping crew members, or even violent attacks. These crimes usually happen in international waters or near coastlines that aren't well protected. Hotspots for ocean piracy include places like the Gulf of Aden and the northeastern coast of Africa. Pirates often use small, fast boats to launch surprise attacks, and they are not picky in what type of boat they choose. They'll go after anything from a fishing boat to a cruise ship to a cargo ship. It's basically any vessel that they think has value. So, why does this happen? One theory that helps explain is the social disorganization theory. This theory says that crime is more likely to occur in areas where social institutions are weak. Things like government, law enforcement, education, and economic stability are weak. When those systems break down, people are more likely to turn to crime. In the case of ocean piracy, we see this clearly. Many of the regions where piracy is common have weak or absent governments. There's little law enforcement on the water, and economic hardship is widespread. If the waters aren't protected, pirates will come. If boats don't have a radar or security, they are easy targets. Vulnerability is key here, as piracy flourishes in places where there's no one to stop it and where people feel they have no other way to survive. The preceding discussion of ocean piracy interpreted through social disorganization theory illustrates how weakened institutionalized structures and systematic instability can facilitate criminal activity. This framework emphasizes the role of environmental disarray in shaping opportunities for crime. To further examine the relationship between structural conditions and individual behavior, the focus now shifts to mortgage fraud. Unlike piracy, which often occurs in regions with minimal governance, apologize. Minimal governance. Mortgage fraud typically arises within regulated financial systems. However, it similarly reflects the influence of broader social and economic pressures. To analyze this form of white-collar crime, string theory provides a relevant conceptual lens emphasizing the disjunction between culturally prescribed goals and the means available to achieve them. So, let's dive further in. What exactly is mortgage fraud? Well, mortgage fraud is when someone lies or hides information on a mortgage application to get a loan or better terms. There are two main types. First is fraud for housing. This is where someone lies to qualify for a home they otherwise couldn't afford. Second is fraud for profits. This is where professionals like real estate agents or lenders manipulate the system to make money, often involving multiple people or properties. Common tactics include inflating income, hiding debt, using fake buyers, or exaggerating property values. It might seem like a harmless shortcut, but mortgage fraud can seriously damage financial institutions. It can inflate housing markets and lead to foreclosures and economic instability. To understand why people commit mortgage fraud, we can look at string theory. String theory says that crime happens when there is a gap between societal goals and the legitimate means to achieve them. In other words, when someone wants something, like a home, but they can't get it through legal or fair methods, they may turn to crime. Think about the pressure to own a home. It's seen as a symbol of success, stability, and adulthood, but not everyone has the income or the credit to qualify. So, some people feel forced to cheat the system, maybe by exaggerating their income or hiding their debt. String theory offers a useful explanation for mortgage fraud by highlighting how individuals may engage in deviant behavior when legitimate avenues to achieve socially valued outcomes are obstructed. This perspective foregrounds the role of structural inequality and perceived injustice in motivating fraudulent conduct. However, not all criminal behavior is driven by long-term goal frustration. Some offenses are better understood as acts of opportunity that occur in the context of routine daily activities. Insurance fraud, for instance, often involves exploiting procedural vulnerabilities rather than responding to structural strain. To account for this shift in motivation and context, routine activity theory offers a more suitable explanatory model, focusing on the convergence of motivated offenders, suitable targets, and the absence of capable guardians. So let's talk more about this. What exactly is insurance fraud? Well, insurance fraud is when someone deceives an insurance company to get money or benefits that they don't deserve. It can include false claims like exaggerating damage or injuries, staged incidents like faking a car accident, or even burning down a home for the payout. Can also include lying on forms to get better coverage or lower premiums. Insurance fraud may seem like a victimless crime, but it affects everyone as it drives up premiums, it drains resources, and it makes it harder for honest people to get help when they actually need it. To explain insurance fraud, we can look at the routine activity theory. And this theory says that crime happens when three things come together. The first thing is a motivated offender. The second is a suitable target. And the third is the absence of a capable guardian. Let's break that down. First, you need someone who is willing to commit a crime. That, in this situation, is someone in financial distress or someone who sees an opportunity to make easy money. Second, you need a target. In this case, it is the insurance company because they are perfect for this, as they rely on trust and paperwork. Third, you need weak guardianship, meaning there is no one around to stop or catch the fraud. That could be slow claim processing, limited audits, or just a lack of oversight. For example, someone might file a false injury claim after a minor accident because they know the company probably won't investigate. The system is vulnerable and the person takes advantage of that. So, to wrap up, we looked at 3 different types of crime: ocean piracy, mortgage fraud, and insurance fraud. And we used 3 different criminological theories to explain them. We used social disorganization theory, string theory, and routine activity theory, as each theory gives us a different lens of how these crimes relate to each theory. Um, so I think it's important for us all to um, know that social disorganization theory focuses on broken systems, string theory looks at blocked goals, and routine activity highlights opportunity and vulnerability. So I thank you for listening, and I hope you all have a great day. Thank you.